Hi guys, welcome to Practical Trader. If you would have been around share markets, I bet you would have heard about the bull and bear markets. The term bear and bull are often used to describe general actions and attitudes or sentiment either of an individual asset or the market as a whole. Investors use the term bearish or bullish as a way to describe their market sentiment regarding specific security or financial markets. A bear market refers to a decline in prices, usually for a few months, in a single stock or the market as a whole. In contrast, a bull market is when prices are rising. Typically, a move of 20% or more from the recent peak or trough triggers an official bear or bull market. Have you ever wondered from where the bulls and bears name came from? Interestingly enough, the actual origins of these expressions are unclear. But one of the interesting explanations I found was the terms bear and bull are thought to derive from the way in which each animal attacks its opponents. That is, a bull will thrust its horn up into the air while a bear will strike down. These actions were then related metaphorically to the movement of a market. If the trend was up, it was considered a bull market. If the trend was down, it was considered a bear market. If we consider the economic activities, the nation grows with its industries or GDP. Now, because the businesses whose stocks are trading on stock exchanges are participants in greater economy, the market and the economy are strongly linked. A bear market is associated with a weak economy as most businesses are unable to record huge profits because consumers are not spending nearly enough. This decline in profits, of course, directly affects the way the market values stocks. In a bull market, the reverse occurs. As people have more money to spend and are willing to spend it, which in turn drives and strengthens the economy. In a bull market, the ideal thing for an investor to do is to take advantage of rising prices by buying stocks early in the trend if possible, and then selling them when they have reached their peak. In the bull market, any loss should be minor and temporary. An investor can actively and confidently invest in more equity with a higher probability of making a return. In bear market, however, the chance of loss is greater because the prices continuously fall and the end is often not in sight. Even if you decide to invest with the hope of an upturn, you are likely to take a loss before any turnaround occurs. Thus, most of the profitability will be found in short selling or safer investments such as fixed income securities. In addition, you may benefit from taking a short position in a bear market, profiting from falling prices. There are several ways to achieve this, including short selling or buying put options. Both bear and bull markets will have a large influence on your investments, so it's a good idea to take some time to determine what the market is doing when making an investment decision. Remember that over the long term, the stock market has always posted a positive return. Thank you and happy investing.